Hey everyone, welcome back to the Financial News Podcast. In today's episode, we're going to break down the four biggest economic stories from about the last 24 hours or so that are moving markets. We'll cover why stocks opened so strong but then reversed sharply into the red, the newest job market data and what it means for Fed rate cuts, big moves in treasury yields, and the latest ripple effects hitting other asset classes like crypto and real estate. All right, so let's jump right in. The first story is, of course, Nvidia. From Yahoo Finance, Reuters, and Barron's, the company once again beat out expectations with strong revenue and earnings, and their forward guidance was solid too. So, in my opinion, what more could markets really ask for? Their CEO, Jensen Huang, also pushed back on the idea that AI is in a bubble, saying demand remains extremely strong. And me personally, I totally agree with that. Normally, this would be kind of a beat and raise quarter that would push the entire market higher. And in fact, it did at the open. Stocks jumped early, especially in tech. But despite the good news, the markets couldn't hold their gains, which leads us directly into story number two. Today's jobs report sent mixed signals and confused the market. So per the Wall Street Journal and The Guardian, the U.S. economy added roughly 119,000 jobs, well above expectation of about 51,000. But unemployment also ticked up, wage growth slowed, and revisions to previous months weren't great. So this is one of those good but also bad labor reports. For example, we had more jobs than expected, so the economy is still resilient, but we had rising unemployment and slower wage growth, which are signs of cooling. So that mix creates uncertainty about the Fed's next move, and that uncertainty sets the stage for our story number three, why the stock market started the day up but then finished down. This, to me, was the most dramatic part of the day. Stocks opened strong. On the S&P 500 was up nearly 2% at one point, but then completely reversed and closed sharply lower. According to the Economic Times, Yahoo Finance, and Scripps News, here's what happened. Investors started the day celebrating Nvidia's earnings and hoping the mixed job data might give the Fed enough reason to continue with rate cuts soon, and that pushed tech, crypto, and growth stocks higher in the morning. However, midday was a little different. As analysts dug deeper into the jobs numbers and bond market pricing, the narrative definitely shifted. There was a stronger than expected headline number, and that made some investors fear the Fed might not cut rates as soon as they'd hoped. And by soon, I mean their meeting starting December 9th. Additionally, there were some valuation worries. Even though Nvidia beat expectations and has been beating expectations, the AI sector has run so far so fast that investors worry valuations might be stretched. When Nvidia's early rally fizzled, that added to market anxiety in a pretty big way. Then there was a risk-off reversal. By early afternoon, traders started taking profits, rotating into safer assets, and reducing exposure into high multiple tech stocks. Bitcoin also sold off, contributing to the broader risk-off tone. And the result was a huge intraday swing from solid gains in the morning to steep losses by the end of the day. This kind of reversal, in my opinion, is signaling that the market is nervous about interest rates, valuations, and direction of the economy all at once. All right, let's talk bond prices for a minute too, and their pullback. Kind of remaining a critical wild card here. All right, so the 10-year Treasury yield dipped slightly from 4.13% to 4.09% during the day on Yahoo Finance. On its own, that move isn't huge, but the trend matters. You may know this, but just for context, falling yields can help real estate, mortgages, and growth stocks. Rising yields increase borrowing costs and often hurt valuations. Right now, yields are bouncing within a tight range because investors just don't know what the Fed will do next. Some strategists say bonds are better positioned heading into next year, but uncertainty remains really high. And that leads us to the final point here, which is ripple effects across crypto, real estate, and alternative assets. So even though today wasn't heavy on direct real estate data, these macro moves absolutely influence real estate and crypto markets. Crypto fell sharply alongside the stock reversal, which is another sign of risk-off sentiment. Real estate sentiment is tied closely to treasury yields, and any expectation of future Fed cuts boosted housing demand, and pretty significantly in the recent past, especially once we got mortgage rates upwards of 7 and 8%. At the same time, stickier inflation or strong jobs data tends to push mortgage rates up and cool the market. And finally, tech infrastructure spending, especially AI and data center investments, remains one of the strongest areas of commercial real estate demand. So there's definitely a lot that happened today. Here's a quick recap. So Nvidia crushed earnings, but high valuations kept investors cautious. The jobs report was a mixed bag, creating confusion about the Fed's next move at their December meeting and beyond. The market opened strong, but reversed hard as traders kind of reassessed interest rate expectations. Bond yields dipped slightly, which are a key driver of mortgage rates and valuations. And finally, crypto and real estate felt the ripple effects of the shifting risk sentiment. So thanks for watching. As always, we try to keep this quick and concise. If you found this helpful, hit the like button, subscribe, and tap the notification bell so you don't miss the next update. We were traveling in Asia last week, but we're getting back to normal with jet lag and hoping to get back into a normal cadence now. So you'll be having more news out soon. So hope to see you in the next one. Thanks for listening.